Hi everybody, welcome back. It's Brian Foote, Convexity Hunter, reminding you to like and hit the subscribe button. Over the weekend I read a very interesting question. What companies possess the widest moats? This is the best time of the year, I think, following the Berkshire Hathaway annual meeting, that people come back and reassess what it really means to be an investor. And part of really being a world-class investor, I think, is understanding the durable competitive advantages of companies, which is what Buffett instructs us to do. It is not the only criterion you should follow, because there's a price for everything. Value investors, and especially convexity investors like us, we like to get these great businesses at great prices. But what actually defines a great business and what defines a moat? I think the first thing is intangible assets: brand equity, patents, trademarks, regulatory license. Having these assets, you have pricing power, you have customer loyalty, and therefore you make replication difficult. And some examples: this is not a recommendation to buy, sell, or hold. These are merely examples, and you should think of some as well. LVMH, Johnson & Johnson are two that come to mind as companies that have brand equity and regulatory licenses. There are many others, and again, this is not a recommendation to buy or sell these companies. It's just an indication. And comment below as to companies you think that possess intangible assets. The second one: switching costs. That's a simple one, right? How sticky to the customer is this company? When it's costly in time, money, or disruption to change providers, customers stay longer. The extreme case is your local utility, but think of sticky software. Think of integrated platforms. You'll hear this a lot with defense contractors. Proprietary workflows. You'll hear this with consulting firms. Software: Microsoft and Adobe are the first big ones that come to mind. It's very, very difficult to switch from either of these companies. In fact, I prepared this on a Microsoft Word and Adobe Acrobat. So there's an example there. What's criterion number 3 for a moat? Network effects. This is something that over the past 25 years has become extraordinarily important with the rise of the internet as a strong part of everyday life. Products or services become more valuable as people use them. Walmart pioneered a network effect for retail. Of course, they built upon prior companies, but Walmart is the prime example of creating a network effect in the physical world. Amazon bridged the internet world to the physical world. You have what is defined as exponential utility and therefore defensibility. And in the case of Amazon or Walmart, a winner take most environment. Some other examples include Visa, Alphabet, or aka Google, and Mercado Libre down in Latin America. Again, none of these are buy, sell, or hold recommendations, but it's pretty obvious that when you look at these three companies, American Express is a prime example as well, right? So interchange Visa with American Express, or Mercado Libre, which is really, as they call, the Amazon of Latin America. Number 4, cost advantage. All right, so that's a pretty clear one. Companies produce at the lowest cost can undercut your competitors, maintain higher margins. Now, this alone is true in commodity companies, right? The lowest cost provider is often the one that survives the longest, full stop, right? There's really not much other advantage other than cost with commodities, right? You really don't care what kind of oil is refined to go inside your car. You just want low cost. The biggest often take all, right? So if you look at the integrated oil companies that can produce oil, it's often at the lowest cost, with the extreme example being the nation of Saudi Arabia, or, to a certain extent, the super major oil companies that are integrated vertically. As a result, you get some strong operational leverages. And of course, Walmart is one, right? The lowest cost provider. In fact, they pioneered the term everyday low prices. And as I noted, ExxonMobil, but you can use examples, Chevron, etc., of the vertically integrated oil companies. Number 5, efficient scale. When a company serves a very limited market, it's not economical for new entrants. So for instance, an infrastructure heavy or regulated industry, think of toll roads. In fact, Buffett often talks about the toll booth companies where you are a utility or utility-like, and then therefore you're able to charge, basically whatever you want. I mean, of course, I always think back on early days when I invested in the French auto routes, which are basically regulated monopolies and extraordinarily well maintained, but concessions that charge a pretty high price to drive around France. Union Pacific is one example, right? The Union Pacific, one of six major railroads in North America. Of course, Buffett owns the Burlington Northern, the BNSF. Prologis, the REIT is another one that does come to mind, where you really have, it's infrastructure heavy. So stay tuned. We have more on this. Again, I brought up some examples of companies. There's many, many more, and I would love to see in your comments which ones you consider to have strong moats based on these 5 criteria.